One, I'm assuming you're not investing in this kind of asset class in New York where it doesn't cash flow. So what areas are you investing in?
It's a great question, and yes, well, we're not that I wouldn't do a deal in New York, especially, as you go upstate, it's more Midwest than it is New York.
Right.
But primarily, we're in the growth markets of the Southeast and the Sun Belt. It's where the jobs are being created. It's where naturally people are moving. And even though our target demographic is not necessarily the baby boomers retiring, what's happening in many of these markets is the baby boomers retire, they could pay cash for a house, and that's taking away a single family house that maybe that first-time home buyer might have bought, and with interest rates and a lot of competition, people are renting for a lot longer than they used to.
A lot longer right now, and it's gotten very hard. The first-time home buyer now, I think, is like mid-30s before you're doing the first-time home buyer. I think I bought my first home in my early 20s, but it was just way cheaper. It was a lot easier back then, or at least a lot less expensive. I know my son right now buying his first house as he's getting married, and we're selling him a house, so making it easy on him. But I don't know how young people do it without going to a house hack or something like that we can talk about. But so investing in the Southeast and the growth areas, and what kind of cash flows do you look for, and what's your sort of sweet spot? Are you looking for a 300 unit apartment building, or are you looking for a 50 unit apartment building, somewhere in between? What's sort of the sweet spot that you see there?
So we like the 100 to 300 unit buildings because they're big enough that a lot of the mom and pops just really can't do that on their own. These are usually syndicated deals where there's a main operating partner, sponsor, or general partner, and they're raising outside money from their network. And so it's too big for the smaller mom and pops, but it's also generally too small for the institutions.
So they're looking for 500 plus or something.
Yeah, or a certain dollar amount. They want to spend
class,
70, 80.
Class A.
Exactly. So,
I see.
So we want to be in that sweet spot that's too small for the big guys and too big for the small guys.
I mean, so I must be a small guy because I'm able to look at something up to about 60 to 100 doors and think that I could pull it off. I recently had something that I think I called you about in North Florida that was 200 doors or so. And it was, honestly, it was too big. I didn't know how to take a bite at the apple. So I felt like I could have possibly gone through the work and gotten a good deal, but I didn't want to do it if I was going to fail. So I backed away from it. So had we been in contact, I think we could have maybe done something like that together, and maybe we can do that in the future.
Yeah, well, exactly. And the one thing is, even for the big guys, it's no easy task to raise. Sometimes it's $10, $15 million, and you need to raise it in 45 to 60 days.
Right.
So part of our business model is we're not competing with our partners. We have partners in multiple markets. Most of them have maybe one or two cities that they're actively investing in.
Right.
And they'll look at 200 deals to find one good one.
Correct. So, that's the right math.
Yeah. So most of our partners only find one or two deals a year to buy. And you can't just have money sitting in a bank account, not earning anything, waiting for that. So you have to wait till you get the deal to then raise the money. And so they'll go to groups like us, in addition to raising from their own friends and family network. They'll go to groups like us that run our own funds and have our own base of investors to also help.
And invite you to take a piece.
Exactly. So we'll partner with them. And our primary role, not our only role, is actually helping raise the money, advising on investor relations. And then, we'll have a seat at the table. They're the quarterback that runs the deal day to day, but there's often a limited partner committee or a investor relations committee where we'll sit in on weekly or monthly calls. It really depends on the deal. Some deals we're more active than others, or other deals we're not actually as active at all, but they'll just give us very special terms. We have one partner that, on a syndication, typically you get your money back plus a return, and often the sponsor, the main partner, takes 30% of the profits after everyone gets their money back, and then investors get 70%.
Right.
We have deals with one of our groups where they'll only take 10% of the profits. So they're taking a 60% fee discount, and they allow us to capture some of that.
Oh.
So our investors get better returns. We get to make part of the spread.
Yeah.
And the operator takes a little bit less. But again, if we're bringing even $500,000 or $1 million to the table, that's 5 or 10 or 15 other investors they didn't have to have hour-long phone calls with. They didn't have to take all that time to build that trust over a period of years. I have some investors I've known for 20 plus years.
Yeah. And then once you find an operator that's doing really good, gets you a return, gets your whole fund a return, they're able to come back to you again and again and again. And that's the way we do it in the mom and pop area, right? So I have investors that I've worked with for years, because we make them a good return as the operator, even on smaller deals. Now, you're just kicking it up a level. I really like your business model too, because you offer them some sort of stable money that they can pretty much be sure that, you know, as long as they're doing the math right and they've proven themselves to you once, they're going to be able to come back to you and say, hey, I need another tranche of 5 million, let's say. And you come in and provide that sort of liquidity for them.
Absolutely, and I feel more comfortable working with these larger, more sophisticated operators, especially, you know, over the last year or two. There's been some challenges with interest rates going up.
Yeah.
And you know, our best operators have proactively negotiated loan modifications on some of our deals that had variable rate debt, and you know, it's handled things far more sophisticated than, say, a mom and pop might have, given some of the, you know, economic challenges over the last few years. So when the going gets tough, you want to be with a sophisticated and well-connected group, and not with, you know, a group of a few guys just getting together to do their first deal.
Well, let's talk about some of those challenges that these operators are having, because I think 2 or 3 years ago even, you could get into one of these projects with the expectation that you're going to be able to borrow the money out at, say, 5% or 6%. And now it pretty quickly went way up. That's a deal killer, right? Like, so if your business model is running on a low margin, say you're thinking you can be a 10 cap based on borrowing the money at 5%, and now it goes to 8%, your 10 cap just basically evaporated, right? So what you're talking about is people that have been able to see this and maybe buy better or figure out how to get better terms. Am I reading that right?
Yeah, so number one is the interest rate moves have definitely created pockets of distress. I talk to a lot of investors who talk about trying to time the market, and a lot of them are residential focused, or think residential is going to crash. I don't see that happening at all, but there's pockets of distress right now as bad as 2008, and those are office buildings, which is a whole separate topic.
Yep.
But also multifamily that was tied to bridge loan debt. 2.5 years ago, before rates started moving, loans were tied to SOFR or LIBOR in some cases, but mostly SOFR. SOFR is the overnight rate. I don't know that. I forget what the acronym stands for, but it's essentially similar to what LIBOR used to be, and so it's very close to the Fed funds rate, which was at 0 or 0 to 0.5.
And now it's at
5.25 to 5.5.
Okay.
So when you look at that on a chart, it's a parabolic move, and you know, it's created a lot of challenges. So you had loans that were at, and the banks charge a spread to that SOFR. So when SOFR was almost 0, most people were getting loans that were in the 2.5% range. Now SOFR went up to 5.5, and now loans are at 8%.
Got it.
That definitely affects the cap rates of the buildings. Now, the cap rate, interest rate does not factor into the actual calculation for a cap rate. However, it does factor in to what the cap rate is, even though it's not part of the math.
Well, it affects your profitability, I guess.
Exactly. So if a new buyer is looking at your building, they're going to factor in their interest rate cost. And so that means they're going to need a higher cap rate, so the cap rate expands.
Right.
And so what that does is it actually decreases the value of those properties. So if you bought 2 years ago when interest rates were really low, you might have bought at a 4, 4.5, 5 cap. Now those same buildings are 5, 6, 6.5 cap in some cases. And that varies depending on the market. You know, high-end markets or markets like Dallas that always have demand, you know, tend to be still a little lower. Tertiary markets or just sort of lower-end properties tend to, you know, require higher cap rates. What that's doing is putting a squeeze on the sale or the refinance. If you thought you were going to sell at a 5 cap and now you're selling at a 6 cap, that's a 20% reduction in value,
right,
or more. And if you want to refinance, that's the other challenge. You don't have 30-year fixed rate debt on commercial. It's usually 3, 5, maybe as high as 10-year debt. But most of these bridge loans...
And it's adjustable.
Exactly. These bridge loans mostly had 3-year terms with perhaps 1 or 2 one-year extensions.
Right.
And so now what you have is these groups coming up to this 3-year mark. And if they got 70% loan to value to begin with, and the cap rates have expanded, maybe they've increased their net operating income by 10 or 20%, but values have dropped 20% because of the cap rate calculation. And what you run into is people are forced to sell, and they're forced to sell at a difficult time to sell.
Right.
And if they want to refinance, they probably need to do a cash-in refinance as opposed to a cash-out refinance, which no one's happy about.
Right.
And so that's what's causing the distress right now. The only people that really are selling right now are generally forced to. If you bought a property in 2020 and you had 7-year debt, and you have a 3% interest rate, there's no reason to sell right now. You're making money hand over fist because you still have inflation, you've had rent growth,
right,
and your interest rate cost is fixed. So you just keep collecting that money, and you wait out your full 7 years before you sell.
And you wait and pray. And you pray that the interest rate comes down before 2027, right? Like you're at the end of your 7 years. And if it doesn't, there's going to be some more pain. Hey guys, thanks for watching that. Subscribe to our channel, watch this next, and then also check out the pinned content for more great content, guys. God bless.